Good morning, everyone. I am back with Clint Lee and Ted Bauman for another installment of Your Money Matters. Now, again, we filmed these on Fridays, so we are coming off the heels of a really ugly day yesterday in the market. The Dow had the worst day it's had since March. It shed nearly 7%. So today we're seeing something of a bounce. And Clint, I actually wanted to start with you. Do you think this is a pause in the rally? This volatility that we're seeing now, or do you think it's a more serious pullback?
Yeah, so that's the debate that starts to open up, especially when you see the Dow drop over 1,800 points in one day. Is this a pause, or is this the start of something more meaningful? And there's been this ongoing debate about whether or not the low that we saw back in March, if that was it, or if we're going to go back and retest that low. In some matter of the sense, it doesn't really matter, because what I'm about to show you with this chart is that even if you think the March low, that was it, that was the bottom, you should still be expecting a pullback. And that's what I want to show you here in this table. This table shows every major bear market low for the last 50 or 60 years now. It shows the date that it was put in, the rally, both the percent advance and the number of days the stock market rallied going into that decline, but then what that first drawdown looked like after that initial leg higher. And on average, I mean, it's a pretty steep pullback. It's about 10% on average, and in every instance, it was 5% or more. So now the key question becomes, are we just seeing a pause in this pullback, or is this going to start to turn into something a little bit more serious? And to those points, there's a couple key charts that I'm following right now that I'll share with you. One's just the S&P 500 itself, and that's because the S&P right now is trading just above a critical level. It's trading just above 3,000, which is a very important psychological level for investors and traders. But then also we find the 200-day moving average right above that level as well. So the combination of that support, it should hold, but if we start to see a meaningful dip in the market below those two support levels, that would tell me that the sellers have the upper hand here. And then in conjunction with the S&P, another chart that I'm watching is the VIX index. That's usually referred to as the fear gauge. You can see, I'll show you the chart here, the spike higher that we had in this index during the depths of the sell-off back in late March. But then this index has come in, it's fallen ever since we've had this rally set in. But just over the last couple of weeks, we've been trading a little sideways here. And we're starting to perk back up a little bit. It's starting to pick back up as the market sold off on Thursday. And so what I would watch here is for this index. You don't want to see this index move above sort of this 40 to 45 level. We see the index move above this 40 to 45 range, along with a pullback in the S&P 500 below that 3,000 level. That would tell me that there's more downside in store for us here.
So Clint, I want to talk in a minute about why I still think that this is a difficult market to navigate, potentially even dangerous if you're not got your thinking cap on. But I just want to ask you something about the chart setup. If I look at what's going on right now, it looks like the market bounced pretty firmly off of sort of a 3250 level, and then and really wanted to get back to around 3,000. And the market was kind of hanging around 3,000 for a lot of last year, particularly during late summer or early autumn, before it took off in November and then peaked in January, which is sort of like what we've seen before in other years, where we get this late summer, early autumn boost. But is it possible that the market overshot earlier this year, and that part of the big drop that we saw was just getting back to where it should be? Obviously the COVID drew it down, but are we getting back to a market level where we should be? Because if we do, that means that the upside is going to be limited for a lot of people.
Yeah, I mean, you could definitely argue, my personal opinion is that the markets are very much a mean reverting mechanism. That means they get stretched too far to the downside as well as too far to the upside. And when that occurs, you have these snapbacks. So to your point, in March, earlier this year, we pulled back too far to the downside. So we've had this big snapback rally to the upside. But then also in late January, I mean, you can go back and look at the charts and look at just where the S&P 500 prices relative to its 200-day and its 50-day moving average. Look at that chart, take it back for a decade.
Mm-hmm.
And you can see in January just how far above, how extended we were above those moving averages, which I'm sure contributed to the declines that we saw.
Right. So the message is that people should be aware that the short-term highs that we experienced, which in a sense created this big drop because we were so high up, we had so much further to fall. Part of that is just because we were so extended. So when you think about getting back to a reasonable position in the market, it might be lower than a lot of people assume. Don't think about the previous high, think about the long-term average. And I say that because I think a lot of people right now are in this gambling mentality, which is what I called it on Friday. Now, the gamblers in the market, the people who are trying to make a quick buck, are generally not, I think, chasing the top stocks. I don't think they're looking for the stocks that are pushing like the NASDAQ top. They're looking for the airlines and the cruise lines. They're looking for, and to be, I hate to say this about Tesla, but they're pushing up stocks like Tesla, which are also, in my opinion, overvalued. But that part of the market is purely sentiment driven. In other words, they tell themselves that they're doing it because the Fed is backstopping the market, but what they're really doing is convincing themselves of that, and then they're acting on that sentiment. And as soon as something comes out that changes that sentiment, boom, everybody panics, right? Well, which is what happened on Thursday. And in a sentiment-driven market, all bets are off because you cannot know what the odds are because it's a herd mentality. Everybody goes up at once, everybody goes down at once. But something I wanted to point out that we saw this morning, which I think is still unfolding, is that in the overnight trade on Thursday night, we saw a lot of big institutional investors bidding up stocks. And then everybody came in, there was buying activity, strong volumes in the first couple of hours of the session. And then all of a sudden the prices started falling again, which tells me that there's kind of a fishing expedition going on by some of the big guys. They're trying to tempt people into buying at higher highs so that they can cash out at a higher premium, which is precisely what you'd expect to see under these kind of circumstances. But let's go back to the fundamentals, which, as you know, is my thing. We've seen a lot of revisions to the job figures that got everybody excited. And it's clear now that the actual, first of all, those figures are not as reliable as they normally are because of a huge reduction in the number of people surveyed. The critical thing is that we're now really looking at about 17 to 19% probable unemployment relative to the way it's normally measured, as opposed to the 13% that made the news. And this is why it's so important, I think, that sentiment can really cause problems. Because if you're in a sentiment mode, 13% you jump, you buy. But then as the news trickles out, the market gradually falls out from under you, and where are you? So whatever you do, don't buy at the top right now. So that's my initial comment. Angela, what do you think?
I think that this is an impossible market practically to navigate on your own. I mean, it is all over the place. News that you think would make the Dow drop is making it go up. And then the next day, that same news is having the exact opposite effect, and then you can't even rely on the news that we're getting, like the jobs numbers.
It's like a flock of starlings, kind of. And I don't mean to be critical of individual investors. Everybody's trying to make money in here, but when you get people like this guy from the sports betting, I forget what his name is, basically saying that he's better than Warren Buffett, you're in danger territory. And let me illustrate a couple of fundamental reasons for that. Here's a chart that shows the inflows into the high yield junk or corporate bond, basically the junk bond ETFs over the past 12 months. And as you can see, it's just been money piling in big time. These are people who are buying exposure to companies that are, many of which are on zombie territory. Companies that can only survive if they can continue to get cheap debt rolled over at very low interest rates. And people are gambling that this is going to continue indefinitely, as though the job of the Federal Reserve is to keep uneconomical companies running, right? So that's certainly not a wise long-term play. All I can say is make sure you get up for the top if you can figure out when it is. The second chart just shows, again, some of this gambling behavior. I showed this on Friday, but it shows companies that have actually declared formal bankruptcy this year, and the 2-week change in their stock prices after that. And it just boggles the mind. I mean, legally, when a company goes bankrupt, once that process reaches a certain part of the court stage, typically they are delisted involuntarily, and shareholders are wiped out. Now, again, some people bought these shares thinking that they could get out before it happened, but that's not investing, right? That's gambling. That's gambling. And so that's what I think we're seeing. Now, again, I mean, you can be smart about this. We've been smart about this. I showed a chart on Friday that showed how much gains we've returned on targeted investments in value opportunities in sectors that have resilience, have strong balance sheets, etc. That's great. But what I would never advise anybody reading my newsletters to do is to buy a bankrupt company in the hope that it's going to go up by 100%, and that we'll figure out when to time it. So I restate, that's my case.
So going back to the original question, is this a pause or is this a pullback? Are there any other clues that either of you are looking for in the economy that might indicate which direction we're headed in?
Ted and I, earlier this year, during the depths of the sell-off, we presented this checklist of factors you'd want to see put into place to know that the economy and more importantly, the stock market was starting to recover. So some of the items on that checklist, one was federal stimulus. You know, we saw a lot of stimulus from both the Federal Reserve as well as the government. So we're hitting that mark. Another mark was to see an improvement in economic data coming in. Now, you can argue whether or not that we're starting to see that. In the headline numbers, we've seen that a little bit, but as Ted was just discussing, when you look underneath the hood, things aren't maybe as what they seem. So the jury might be out a little bit on the improvement in the economic data as more and more states are reopening their economies. We'll see if that trend starts to improve. But probably one of the most critical factors to keep an eye on right now is simply the number of new COVID-19 cases. And I'll show you a chart here. This is the number of new cases and what that average looks like over several days. And you want to see this number continue to drop, obviously. You know, with the economic shutdown, with the lockdowns across the country, that's had a good impact in driving this number lower. But the concern is if we start to see a bump up in the number of new cases, if we're going to have to resort back to the types of lockdowns that were having such that dramatic impact on the economy and the stock market.
Right. Well, absolutely. And I think the two things I would say in response to that. One is that the signals about stimulus are mixed. Initially, there was a feeling that a second stimulus would be required. Then over the last month or so, early in the month, we saw the Trump White House and the Senate Republicans basically saying they didn't think that was going to be necessary, or they were going to do it in such a way that it would only be partial. Now we're seeing the opposite. Now we're seeing Steve Mnuchin saying we have to have more money. The Fed has been saying all along, hey, Congress, you have got to spend money to restart this economy. And that goes back, I think, to a fundamental point that so many people miss about this situation. When you see these big declines in unemployment, and then by contrast, these recoveries in unemployment, what you're seeing is what I call the first line of employment. You're seeing people who are in service industries who are earning money, doing things like working in restaurants, retail stores, that they're working in entertainment establishments, the things that are reopening. Those people's salaries and the money that their employers spend on things like supplies and equipment and all that sort of stuff, that's what drives the second tier of the economy, which is, you know, grocery stores, retail stores that sell clothing, discretionary goods, basically. So the problem that a lot of people, I think, have is that they look at that headline employment number and they think, wow, it went back up again. But it went back up again for people at that first level. The critical question is, are the second level and then the third level, which is the manufacturers, are they going to be spending money getting ready to ramp up production? Do they think that there's enough spending in the economy to drive and justify that in the second and third levels? Because if not, then what we have is a situation where we've got a lot of half-empty restaurants. They're half full, true, but then we have the rest of the economy not operating up to scale. And eventually that translates into lower economic activity, deflation. We have all these problems. People ignore that. They just focus on the job number and think a job is a job is a job, but it's not. A job in a restaurant is not the same thing as a job on the assembly line making automobiles or any other heavy consumer good, and that's where economic growth comes from. So to me, the jury's still out. Even reduced numbers of cases does not change the calculation if corporate investment is not happening, if people are not prepared, if procurement managers and others are not planning for increased sales. If they're not, this is not going anywhere.
So whether it's a pause, whether it's a pullback, could you call it an opportunity either way?
It's always an opportunity. And I think if you're smart and you look for the stocks that are essential but yet beaten down, which is what we've been doing, yes, you can make pretty significant gains at much lower risk, I would add. Because part of what the difference is between what we're doing, and I think what some of the people who respond to our videos is doing, is that they're willing to accept an extremely high level of risk. Our strategy is to try to balance risk and reward. And I think if you do that, you look for the beaten down stocks, you look for strong dividend payers that are cheap right now so that you can lock in high yields going forward. That's a smart move. If you can afford to gamble, gamble. I have no problem with that. But I think we don't know whether this is a pause or the signal of a turn yet. As I've said all along, when the second quarter numbers come out in July, that's when the proof of the pudding is going to happen. When we see what happened to GDP, when we see all the manufacturing indices. So I've said all along, that's the critical point.
All right, great. Well, I think this was helpful. Thank you, Clint. Thank you, Ted. And again, for more information on the Bauman letter to see how we are beating the market, please click the link above or below. And thank you again.
Great.
Thank you.